NVIDIA's stock is the market's pressure cooker, and the first thing you need to know before we sprint through valuation, growth, macro, competition, risk, and catalysts is that everything hinges on whether the artificial intelligence demand frenzy can keep outrunning gravity. Right now, the share price bakes in near flawless execution, so hang tight because in the next few lines we dissect how rich those expectations really are, why Wall Street still loves the story, and what could knock it off its perch. Straight to valuation, trailing price to earnings hovers near 52 times, forward earnings around 32 times. Those levels crush NVIDIA's own 5-year average and dwarf old-school chipmakers' multiples. Yet surprisingly, the price-to-earnings to growth ratio sits close to 1.13, almost identical to advanced micro devices. On paper, that implies growth is at least partially keeping up with price, but do not get comfortable. The absolute metrics scream premium. Price to sales is roughly 26 times and price to book near 46 times, beating advanced micro devices by about triple on sales and 12 times on book, while Intel languishes around 1.85 times sales and 1 time book because it dipped into losses. Keep focusing because in a few moments, we will layer in revenue momentum to show why investors tolerate this heat. Momentum next, fiscal 2020 saw revenue of roughly $11 billion and net income of about $2.8 billion. 2 years later, revenue hit nearly $27 billion, profit near $10 billion, then the lull, fiscal 2023 stalled. Many bears called peak gaming, peak crypto, peak everything. They were 1 year early. Fiscal 2024 delivered over $60 billion in revenue, up 125%, and net income exploded to nearly $30 billion, 6 times higher. Blink again, fiscal 2025 doubled revenue to around $130 billion and pushed net income past $70 billion, roughly another 145% jump. That chart line is vertical. Up next, we will tie those leaps to the data center gold rush. Why so vertical? Because the hyperscalers, Amazon Web Services, Microsoft Azure, Google Cloud, Meta, and their global peers ripped open their CapEx budgets for generative AI clusters. Industry trackers like Deloitte pegged generative AI-specific chips at more than $150 billion of global demand in calendar 2025, and NVIDIA owns well above 90% of the advanced graphics processing units used in large model training. While central processing unit shipments remain tepid, accelerated computing lives in hypergrowth. NVIDIA's quarter just closed, booked roughly 90 cents of every dollar from data center customers, meaning gaming and professional visualization revenues now look like side gigs. Stay tuned, because we will examine whether this monstrous share can hold once advanced micro devices and Intel finally ship competitive silicon. But first, the street view. Nearly every major sell-side desk remains positive. TipRanks collects 40 analyst price targets and shows an average near $175 per share, about 10% upside from where we stand. Stock analysis lands roughly the same. Only one lonely analyst among more than 80 calls the stock a sell, while a handful market hold. Yes, pockets of skepticism exist. Morningstar's intrinsic value model sits 20 to 30% lower, but the consensus message is clear: keep buying unless growth stalls. In a moment, we will ask whether monetary policy could be that stall trigger. Macro matters because high discount rates eat high multiples, and the Federal Reserve is keeping its policy rate in a range near 4.5%. Dear Jerome Powell recently told Congress inflation is still somewhat elevated and hinted no cuts are imminent. Every quarter that rates stay lofty raises the hurdle for NVIDIA's forward cash flows to justify present valuations. Add in fresh tariffs and an election cycle that may dial headline risk to 11, especially if a second Trump term re-escalates trade wars and investors must weigh policy danger alongside product demand. Stick around. In a few sentences, we address export controls on China, the single most material geopolitical overhang. Washington's chip export ban forbids shipment of top-end processors like the H100 to China under rules stiffened in late 2023. Bank of America estimates that policy could slice $15 to $20 billion in annual revenue. NVIDIA already booked an inventory write-down of roughly $4.5 billion because units built for Chinese customers became unsellable overnight. Management pivoted by offering slowed-down versions that meet licensable thresholds, but Chinese cloud giants may ultimately migrate to domestic accelerators from firms such as Biren or Huawei. Right here is where political risk gets real. A White House decision, no matter who occupies it, to tighten controls again would immediately subtract earnings power. Critics of the prior administration point out that the ad hoc tariff spasms of 2017 through 2019 hurt corporate planning and arguably pushed Beijing to double down on indigenous chip efforts. Supporters say pressure was overdue. Either way, both major parties today signal a tough on-China stance, meaning the constraint will persist. Competition time, Advanced Micro Devices' new MI300X looks good on paper, offering enormous high-bandwidth memory, but its software ecosystem still trails NVIDIA's CUDA by years. Intel's Ponte Vecchio and Gaudi lines show incremental progress, yet yields, power efficiency, and developer tooling lag. Hyperscalers are not waiting idly though. Google's TPU v5, Amazon's Trainium 2, and Microsoft's in-house Maya chip target training workloads intentionally to loosen NVIDIA dependency. Each design raises the possibility of pricing pressure, and once second source capability feels safe, the order book may split. The catch, even if hyperscalers adopt custom silicon, they still validate their models on NVIDIA hardware first because the toolchain, driver stack, and community support remain unrivaled. That moat is software, not metal. Replicating it takes a decade. Shortly, we will pivot to margins to see how firm the moat really is. Gross margins soared into the high 70% range over the past year, fueled by a supply chain where foundry partner Taiwan Semiconductor Manufacturing Company bears the capital costs while NVIDIA collects economic rent through architecture leadership. Those margins are breathtaking for hardware and exceed many pure software firms. They also amplify downside if volume normalize. Bears argue that once competitors claw to feature parity, hyperscalers will demand severe price cuts, and at 70-ish gross margin could compress by 10 points or more, wiping out several dollars of earnings per share. Bulls retort that a new architecture, Blackwell, will ship in volume this fiscal year at even higher list prices, and condensed chiplet designs mean cost per transistor still trends down, shielding margin. Keep reading. Next, we turn to the balance sheet because liquidity decides how aggressive management can play offense. The company sits on roughly $23 billion of cash against scant long-term debt. Free cash flow in the most recent fiscal year exceeded $50 billion, so buybacks and dividends. Authorization stands around $15 billion for the current year. That treasury lets NVIDIA prepay Taiwan Semiconductor Manufacturing Company to secure priority wafer capacity, invest in internal networking silicon like Spectrum-X and Bluefield, and potentially scoop up strategic software assets. Silicon competitors cannot match that war chest, giving NVIDIA strategic optionality. Wait a moment, because we are about to examine valuation again, but through the discounted cash flow lens instead of multiples. A quick cash flow skim, project revenue growth of 50% this year, then taper to 30, 20, 15, and 10% sequentially across 5 years, reflect decelerating adoption once the biggest hyperscaler clusters are built. Apply an exit gross margin of 65% reflecting moderate competition, an operating expense ratio near 20%, and perpetual growth of 3%. Discount at 10%, a rate consistent with today's elevated cost of equity. The model yields intrinsic value near $130 per share, close to Morningstar's view, material but not catastrophic downside relative to the latest quote. Now adjust the same scenario so that operating margin stays near current 50% instead of sliding, and discount at 9% assuming a gentle rate path. Fair value jumps above $170, matching sell-side targets. In short, modest tweaks swing fair price by $40 because current valuation lives in the long tail of future outcomes. We will come back to volatility, but first, consider cyclicality. Semis remain cyclical, even with structural growth drivers. Memory bubbles, crypto mining busts, smartphone plateaus all remind investors how quickly lead times flip to inventories. If hyperscalers overorder GPUs to secure scarce supply, a pause in order flow could leave NVIDIA shipping below normal for several quarters while channel stock drains. Management says lead times are still 6 months or more, indicating strong backlog, but skeptics recall similar talk before the 2018 crypto crash left gaming cards piling in warehouses. What keeps bulls confident is the breadth of workloads moving to generative models, customer support, code generation, drug discovery, and more, suggesting secular rather than fad demand. Time will tell. Next, let us glimpse the lesser-noticed segments. Automotive revenue, powered by the Drive Orin system on chip, hit roughly $500 million last quarter, growing north of 70% year-on-year. That is tiny beside data center but signals optionality. Electric vehicle makers such as Tesla, NIO, and BYD embed NVIDIA compute for advanced driver assistance. Management guides to more than $5 billion in auto sales by fiscal 2026. Meanwhile, the edge computing Jetson line and the Omniverse simulation platform aim at robotics and industrial twin markets. If even one of these adjacencies pops, it supplies incremental top line with potentially software-like margins once subscription layers mature. Software deserves its own flash. NVIDIA AI Enterprise licenses, CUDA libraries, and newly launched microservices basket called NIM carry annual fees per GPU. While small now, recurring license revenue reduces lumpiness, raises switching costs, and could be valued like software rather than hardware. If Wall Street begins to assign a premium multiple to that stream separately, headline price to sales for the hardware bucket could compress while consolidated valuation holds. Watch upcoming earnings calls for separate disclosure. If they break out software explicitly, that is a tell. Risks recap in rapid fire, stricter export curbs, costlier capital amid sticky inflation, over-ordering leading to an inventory glut, credible high-volume entrants by advanced micro devices, MI300 family or custom chips, and headline shocks tied to the United States presidential race or renewed trade hostilities. Catalysts mirror the risks. Blockbuster Blackwell launch, another upward revenue guide driven by hyperscaler capex hikes. explicit software revenue breakout, and continued share buybacks cushioning dips. One more thought on the broader market, tech indices already price aggressive rate cut expectations for the second half of the year. If macro surprises hawkish, every long-duration growth multiple compresses, NVIDIA included. Conversely, a benign inflation print could ignite rotation back into mega-cap growth, propelling share price regardless of near-term fundamentals. This binary backdrop amplifies volatility. Options markets reflect that with implied vol above peers. Let us address the social context briefly because labor and climate angles increasingly shade capital flows. Data center energy consumption is skyrocketing. Environmental watchdogs warn that large language model training sessions devour megawatt hours comparable to small cities. If regulation arrives, carbon tariffs, power usage effectiveness mandates, hyperscalers may hunt for more efficient silicon alternatives or slow deployment. NVIDIA touts performance per watt gains generationally, yet absolute electricity demand climbs. Institutional investors integrating environmental criteria could pressure margins if they demand NVIDIA subsidize renewable offsets. Not an immediate earnings event, but it lurks. Finally, the verdict you came for. Is NVIDIA overvalued or underpriced? The honest, unhedged answer, if you believe artificial intelligence workloads will keep compounding at the current pace for at least 3 more years and that NVIDIA will maintain above 90% share of the accelerator market while holding gross margin near 70%, then today's valuation is not crazy and may even look cheap in hindsight. If you suspect growth will tip from triple digits to merely high teens within 24 months, or that geopolitical shocks will carve a $20 billion hole in revenue, the multiple compresses fast and the equity prints a 30 to 40% drawdown. Both scenarios are plausible. The spread between them is why traders stay glued to every hyperscaler capex headline and every congressional export control hearing. The next quarterly print, due in roughly 6 weeks, will reveal whether data center revenue climbed again sequentially and whether lead time commentary loosens. Any sign of flattening could spark a swift re-rating. Conversely, a blowout and an upbeat Blackwell shipment outlook could force bears to cover, pushing targets beyond $180. Until that data arrives, the stock is a sentiment barometer for the entire artificial intelligence supply chain. A closing snapshot, NVIDIA commands the kind of product lead Intel once enjoyed during the 90s, but in a far bigger addressable market. The moat is real, yet not immune. Valuation sits on a pedestal built from perfect execution expectations. The bull story says the pedestal is marble. The bear story says it is balsa wood exposed to political storm. Pick your side, knowing that whichever view you take, the next 6 months of earnings, rate moves, and policy decisions are going to settle the debate.